Okay, so let's continue our lecture 4 on chapter 5, foreign exchange markets. So in these specialized videos, we try to give the details for a special arbitrage for triangular arbitrage in foreign exchange markets. So first, what is arbitrage? Arbitrage means you can make a riskless profit by buying low and selling high at the same times. For example, I purchase the bottled water from a supermarket and $5. But on campus, $5, for example, a box of 10 bottles of waters costs $5 in a supermarket, but in a on-campus store, for the same brand of water, the price is higher. Is what? Is $1 per bottle. So the whole box will be what? $10. So that's the double of the price in a supermarket. Suppose I can buy in a supermarket and directly moving this water into our campus without any extra cost like the transportation and the other fees. We can sell with what? A doubled price and make a profit. But you may wonder, right? Maybe why buy this water and moving to the campus, I will what? I will cost some transportation fees, and also maybe the supermarket sometimes out of inventory that I cannot make a riskless profit. So how can I do? Maybe I can do what? I can ask my friends to purchase the water in a supermarket, and he will pay what? $5. And then I borrow the water from the on-campus store and sell directly to what? To the students for $10. Then my friend will deliver the water into the campus and I will pay the water back to the on-campus store. So there will be what? There will be no such risk if you can buy and sell at the same times. In these situations, I ask my friend to buy the water and I sell the water on campus simultaneously. So that will be involve what? Riskless profit. But the chance is very real. If this chance existed, right, anyone can get this profit, so they will rush into the market. So the chance will be very soon gone because the price of the supermarket either go up or maybe the price of on-campus water will going down, right? So they will make our balance. So that's called arbitrage. So you can buy and sell at the same time to make profit. Buy low and sell high. That's the key. So how can we use arbitrage in the foreign exchange markets is the topics for this video we try to study. And we have a triangular arbitrage. So let's define what is the triangular arbitrage. Triangular means there are three foreign currency. And for each two of the currency, we have what? We have our exchange rate. but these exchange rates are not exactly matched up. If a market is not efficient, sometimes exchange rate is not exactly matched up. If that happens, then we can make our what? Riskless profit. When our quoted exchange rate does not equal to the market cross exchange rate. And for the wholesale market, our international banks will try to explore such inefficiency in the market and to determine when one currency is overvalued but another market is what? Undervalued. So we can buy low and sell high simultaneously to make a profit. So that's the process of what? The triangular arbitrage. So I summarized these points into my, summarize here. The first one, triangular arbitrage is a form of what? Profit making. So the purpose is to making profit. And how we can do that? How can we do that? The bank is what? The bank will trading the currency using the advantage of what? Exchange rate of discrepancies. So exchange rate is not exactly match up. There are some what? There are some discrepancies between the pair of the exchange rates. And how can we do that? The chance is very real and it will be gone very soon. So you cannot use the human, tapping and calculation to do the calculations. We must use the computer-based tradings. It's called algorithmic tradings. So we actually use our programmings, use the software to explore this chance. To ensure the profits, such trades should be performed quickly and usually in a large size. In the interbank wholesale market, every transaction is in what? Is in a $10 million. So even a small discrepancy, maybe only a cent. But times a high size of tradings, it will be still a appreciable profit you can get, especially in a foreign currency market. Sometimes we have the what? $1 billion transactions. This profit will be huge. But the chance is also real and it will be gone very, very soon. So let's take a look at one examples. We can try to measure how we can use the cross rate we studied from the last video to compare with the market rate to track the discrepancies. Then we will use our arbitrage to make profit. So in these given examples, there are 3 exchange rates from 3 banks. Most likely, A and B, you can see they both involve the dollars. So we suppose this is in a domestic market. And the third one is in the bank C. So this should be in a foreign bank. So you can see bank A quoting the Japanese yen, 82 Japanese yen for $1, and bank B quoted for a British pound is equal to $1.6. For bank C, it will be a quote between Japanese yen and British pound for a pound equal to 128 Japanese yen. Suppose you have 100 million Japanese yen. Can you make a triangular arbitrage profit based on these 3 quotes? Let's take a look for our examples. And these examples will give you a detailed tutorial step by step on how to solve the arbitrage profit. Let's take a look.
Welcome to Triangular Arbitrage Step by Step. In this tutorial, we'll see how to calculate arbitrage profit given three basic currency quotations without bid and ask. Let's take a look at an example.
Okay, so in these videos, he will try to illustrate, right, these three quotes in a triangle.
Welcome to Triangular Arbitrage Step by Step. We'll see how to profit given ask. Let's take a look at an example. Here we have quotations from three banks and we have 100 million yen to work with. Our task is to find out if we can profit from these quotations, and if so, how. It's easier to work with a problem of this nature by visualizing it. So as our first step, we are going to draw a triangle and place the three quotations on its angle. It doesn't matter what angle we place what code. In step 2, we need to identify the quoted cross rate. Since the code provided by Bank C pairs 128 yen to the British pound and not the US dollar, that is, the quoted cross rate. In step 3, we find the implied cross rate using the other two codes. So we multiply 82 yen per dollar by $1.6 per pound to come up with yen per pound implied cross rate. The result is 131.2 yen per British pound. In step 4, we compare the quoted cross rate to the implied cross rate. If the two numbers are the same, there is no arbitrage possibility because we'll be selling and buying the yen at the same price. In this example, there is a difference as indicated by the two numbers that are circled. We therefore conclude that an arbitrage possibility does exist. Our goal is to sell the yen and buy the yen back to wind up with a higher yen amount. There are two possible ways to do this. Since Bank C is prepared to trade yen for pounds, we can first sell yen to Bank C for pounds. We then take our pounds to Bank B and convert them to US dollars. Our last transaction will be with Bank A to sell dollars and buy yen. If we wind up with more yen than we started out with, we've made an arbitrage profit. Another alternative would be to start with Bank A, do the transaction with Bank B, and finally with Bank C, as shown by the red dashed line. We can do calculations both ways and see which one of the two paths is profitable, or we can analyze the two alternatives and rule out the unprofitable alternative. Let's do our analysis. If we start with Bank A, we pay 131.2 yen to receive a pound. If we start at Bank C, we pay a lower amount of 128 yen to receive a pound. Obviously, we want to pay a lower amount, so we start with Bank C and not Bank A. In step 6, we sell 100 million yen to Bank C and receive 781,250 British pounds. Now we sell the pounds to Bank B and receive 1,250,000 US dollars. We make the final transaction with Bank A and sell the dollars to Bank A to receive yen. We now wind up with a higher yen amount than we started out with. In the final step, we calculate our arbitrage profit by subtracting the initial amount from the final amount. In our example, this amounts to 2.1 million yen. Had we started with Bank A, we would have lost money. Thank you for watching this tutorial. I hope it was helpful.
Okay, so this tutorial is very organized and very clear in explanation, so that's why I try to show this video to give you a basic understanding of the triangular arbitrage and the steps. But after we watch this video, I want to point out there are something very good for this video, but there are also some drawback of these videos I want to point out. First one, you see in these videos, he suppose you have what 100 million yen, and then you get this 100 million yen to do the investment and try to determine arbitrage profit. But as you know, in the global markets, over 80% of the transaction is involved of what? US dollars. So it's more typical to assuming our investors were at first holding what? Not Japanese yen, but holding what? But holding the dollars at first. So in your pocket initially, it's not yen, but should be the dollars. Now we can change our question to get our new calculations. So suppose you have $100 million now. Can you make an arbitrage profit? We will follow his steps, but let me give you a shortcut. Will be even more convenient than his calculations to solve arbitrage profit, because he wants you to try two paths, either formula B or formula A. Then maybe you choose the wrong path, you need to do another point again, right, to score this profit. For example, from a point you solve it is not a profit but a loss, then you need to starting from another point to solve the profit. So it's not very good. So I will give you a way more straightforward than this video. And also we will use more popular currency like the dollar, right, to solve this problem. So first, the step one, still the same. We must what? We must visualize our triangle. This triangle involves the three currencies and the three quotes. So we still use the same triangle in the videos. So A is the yen and dollars, B is the dollar to pound, and C is the the indirect quote between the yen and what? Pound. So basically this is what? This is a cross rate. And from this domestic market, we can solve our what? We can solve our implied cross rate. And this cross rate is directly from our implication of the domestic market. And this rate will be compared with the foreign market rate. If these two rates are not exactly the same, there are some discrepancy, then we have our what? We have a triangular arbitrage feasible to get profits. So your most important step to solve this type of question is to actually get what? Implied cross rate. And this we already done many practice in the last video. So the close rate is the key, is the fundamental for this question. If you solve the wrong close rate, you cannot continue to solve this question properly. So you can see we already from these two quotes solve the implied close rates. And we have the yen to dollar times what? Dollar over pound. So the dollars cancel out. We have the yen to pound. That's equal to what? 131.2. And this number comes from 82 times 1.6. And you can see these two numbers, one's implied, one's the actual market rate. They are not exactly the same, so there has somewhat discrepancies. And you know this is the third market, third quote, and this is our key to determine our transactions because we starting from holding the dollars. We sell the dollars and finally we must to buy the dollars back. So what's the middle? It's based on what? It's based on this quote. And compare with these two quotes, what you found? So from your domestic market, a pound must equal to what? 131.2 yen. But in the foreign market, 1 pound is only equal to what? 128 yen. So in our foreign market, the pound is what? Is undervalued. Accordingly, our Japanese yen is what? Is overvalued. So we always what? Sell something overvalued and buy something what? Undervalued. I buy something undervalued. So first we should do what? We should sell something overvalued. So we want to sell what? We want to sell the Japanese yen. So we sell the yen. Sell yen. To buy what? To buy something undervalued. Is more valuable. Should be, right? So we buy the pound. So now you can see what's the step we should follow. So we're starting from the dollars. That's something different from the videos, right? We're starting from dollars. So first we sell the dollar to buy Japanese yen. That's this one. Then we sell the yen to buy what? To buy the pound. So this one. Last one we will sell the yen to buy the dollar back. So this is in a A, this is in a C, and this is in a B. So our path is from A to C to B. So I think this way is better than the video let you to try two alternative paths, then to determine which one is okay. But my method, you don't need to borrow to compare the two paths. It will be very straightforward. Based on a comparison, you know you will always what? Buy the undervalued. Right? To sell something overvalued is consistent with our rule in investment course. So based on this process, we can do our calculations. Right? So for example, we have the $1. Right? We don't use $100 million directly, but if you want, it's okay. Right? You can use $100 million. Then that's A. When A, we will sell the dollar to buy what? Japanese yen. So $100 million times what? 82 yen per dollar. We got what? We got 8200 million what? Dollars or million yen. That's A dot. And for C dot, we will sell the yen to buy what? To buy British pound. So we have the 8200 over 128. We got what? We got a British pound. Last one, we will sell the pound to get dollars. So we have this pound times what? 1.6. So our final calculations, how much dollar you get back, will be 8200 over 128, then times what? 1.6. That's equal to what? That's equal to $102.5 million. So compare with your initial investment, you got additional $2.5 million as your arbitrage profit. So that's the result for these questions. So you can see our question asking, right, based on $100 million, right, what's your profit? Your answer should be what? $2.5 million profit. So I hope you catch every step I just did from this video. If you cannot catch up with my speed, please go back to the video in the middle and halt and to write down the steps and to practice by yourself to make sure you can solve these numbers. Okay, so that's the question in the examples in the videos, and I want you have some intuitions for these questions, and we will also see a question from our textbook. In our textbook, it's already visualized with a triangle. These triangles also involve three currency, like the dollar, pound, and euro. And also these three currency quote from the three different what? Banks. One's the Barclay, one's the Credit Nice, right? And the other one's Credit Agricole. So let's find out which quote involve what? Dollar. That's the Barclay and the Credit Nice. So these two involve the dollars, so we should get a cross race to compare with this one. So we must to solve what? Euro to what? To pound. Where's euro is here, and our pound is here. So we have the euro over dollar times dollar over what? Pound. You can solve the what? Euro to pound. So we can do a product, right? That's a 0.8833 times 1.4397, and the result will be 1.2717. And this number we will compare with what? This one. So on this market, which one is overvalued? Which one is undervalued? Let's look. You can see here, right? For a pound, it must be equal to what? 1.2717 what? Euros. But in a Credit Agricole, for a pound equal to what? 1.2712. So this number is smaller than this number. What that means? Means our pound is what? Is undervalued. If it's fair valued, should be has what? 1.2717 euro, but here is less. So our pound is what? undervalued? Which one is overvalued? Which one is overvalued? So accordingly, right, one is undervalued, the other should be overvalued. Is what? Euro is what? Overvalued. Overvalued should be what? Should be sell. Undervalued should be what? Buy. So we're starting from a dollar, right? Dollar, we will sell the dollar, right, to buy. This is the beginning, right? It's your initial currency. In the middle here, right? We should always what? Sell something overvalued. So we will sell the euro to buy what? To buy the pound. Then sell the pound to get the dollar back. So that's the process. The first step, we visualize the triangle. Second, we solve the cross rate, then do the comparison to determine which one's undervalued, which one's overvalued. Third step, we will form our process. The fourth step, we will base on the process to solve the arbitrage profit. So let's take a look for our process. Right? Okay, so the first step based on our process, right, should be the dollar to the euro. So we will first sell the dollar to the euro. So that's this one. Then we will sell the euro to buy the what? To buy the pound. Finally, we will sell our pound to get our dollar back. So that's this path. So we have what? At beginning you have the 0.5. You have $5 million. So $5 million will first get the euro times what? Times 0.8833. You get euros. Then you will get what? You will sell the euro to buy what? To buy the pound. So you will divide by what? 1.2712. Finally, you will sell your pound to get dollars. So times what? 1.4397. And after you solve that, you can get what? You can get $5.001915 million. So your profit will be the difference with your final amount of a dollar minus initial money you put into these arbitrage opportunities. So the difference will be 0.001915 million what? Dollars. Don't forget our currency symbols, right? Because we have so many different currency in this course. With a lot of currency, we don't know what's the value of this amount should be, right? So this should be in the dollars, should be what? $1,915. So that's how to solve it. So I summarized this one into a 4-step. Please follow my step to solve the similar questions in our homework for triangular arbitrage. And I also leave a question as a challenge for this topic. In the last videos, we studied the bid-ask spread. We know for the same pair of the currency quote, for example, for Japanese yen and US dollars, there are two different numbers for the quote. One's the bid, one's the ask. And you know, for the interbank wholesale market, our dealer is the bank, is global bank. They were buying and selling the currency to make a profit. They buy low and sell high. So they have the two price. The bid price is how much the dealer willing to buy the currency, and the asking price is the price they asking to sell the currency. So with the two numbers, the bid and ask, both for every quote, how can you make a triangular arbitrage to make profits? So this is, with some additional difficulties, right? Because you don't have just one number for the quotes, but each quote we have the two quotes. One is what? One is the bid, one is ask. Then how you can solve the cross rate? Cross rate we already started, right, in the last videos. Even for the bid and ask, we have the what? Cross rates already started. So place first, you should draw this triangle. Then from these two quotes, you can apply the knowledge in the last video to solve what? To solve the implied cross rates to compare with this one. Then from a comparison, you can determine which currency is undervalued, which currency is overvalued. Then based on your conclusion, you can form the arbitrage process to solve the profit. So I will leave these questions as your practice for this topic. So if anyone solve this one with your, results, please show it in class. When we do the recitation and review, please show this one in class. You will get additional points for this problem. So let's follow the topic of the triangular arbitrage. So this calculation is not very easy. You should practice and also maybe take a look for our video again to get familiar with these calculations, and also try to finish the problems in our homework.